Something just changed, something so significant that if you own even a single ounce of silver, the next 90 days will determine whether you make the trade of a lifetime or watch it slip through your fingers. Because right now, at this exact moment, silver is sitting at a crossroads. One path leads to $300 per ounce. The other leads to a violent shakeout that will terrify 90% of holders into selling at the worst possible time. And the kicker, both paths lead to the same destination eventually. The question is, will you have the conviction to hold through what's about to happen? Or will you be another statistic in the greatest wealth transfer in commodity history? Let's find out. Welcome to the Hidden Economy. Hit subscribe right now because what I'm about to reveal is not just price prediction. This is a psychological warfare manual for silver holders. And if this video helps you prepare for what's coming, drop a comment saying diamond hands so I know you're ready. Let's get into it. Okay, I need to be brutally honest with you about something that nobody else is saying. You think you're ready for silver to go higher? You think you'll hold through anything? You think you understand volatility? You don't. Not even close. And I can prove it. Pull up a chart of silver from March 2020 to March 2021. Look at what happened in that 12-month period. Silver went from $12 to $30, a 150% gain in 1 year. Incredible, right? Life-changing money for anyone who held. But here's what the chart doesn't show you. Here's what nobody talks about. In that same period, silver had 7 separate pullbacks of 10% or more. 7 times where silver dropped violently, seemingly out of nowhere. 7 times where holders panicked. 7 times where people who said they'd hold forever sold in fear. On September 1st, 2020, silver hit $29.84. 2 weeks later, it was $23.91, a 20% drop in 14 days. How many people held through that? How many people who bought at 28 US or 29 watched their position lose 20% and thought, this is it. The rally is over. I need to get out. Most of them, they sold at $24 and then they watched silver climb back to $30 4 months later. They gave up right before the finish line. Let that sink in for a second. The people who could have made life-changing money, the people who were right about the direction, they still lost because they couldn't handle the psychological warfare. And here's the uncomfortable truth. What's coming next is going to make that look easy. What's coming is going to test you in ways you cannot imagine. And most of you will fail the test. Now let me show you why I can say that with such confidence. Because I've studied every major precious metals bull market in modern history, and they all follow the same psychological pattern, every single one. 1970s gold and silver bull market, 9 years from start to peak. How many violent corrections along the way? 14 separate drawdowns of 15% or more. Some lasted weeks, some lasted months. Each one convinced holders that the bull market was over. Each one shook out weak hands, and each one was followed by new all-time highs. 2001 to 2011, gold bull market, 10 years, 12 major corrections. The worst was 2008. Gold dropped from $130 to $680 in 8 months, a 34% collapse. People who bought gold at $950 or $1,000 watched their position get destroyed. They held for months as it kept falling. Finally, most gave up around $700 to $750. I was wrong. Gold is done. I need to cut my losses. And then what happened? Gold went to $11,900 over the next 3 years. The people who sold at $750 missed a 170% move from their entry point. They were right about the bull market, but they couldn't survive the shakeout. Bitcoin 2015 to 2017. Everyone remembers Bitcoin at $20,000. Nobody remembers the journey from $200 to $1,200 by January 2017, then crashed to $750 by March, a 38% drop in 6 weeks. Most holders panicked and sold. Bitcoin then went to $20,000 over the next 9 months. The sellers missed a 1,500% gain from their entry because they couldn't hold through one correction. You see the pattern? Bull markets don't go straight up. They shake out weak hands repeatedly, violently, mercilessly. And right now, you're in one of those bull markets. Silver is in a massive structural bull market that could last another 3 to 7 years. But between here and the ultimate peak, there will be pullbacks that feel like the world is ending. There will be moments where you question everything, where you wonder if you made a terrible mistake, where selling seems like the only rational choice, and that's exactly when you need to hold. Now let me show you what I think is about to happen, and I need you to understand something. I'm not giving you financial advice. I'm giving you a psychological framework, a roadmap of probable scenarios based on historical patterns. What you do with it is your choice. But if you're holding silver, you need to hear this. Scenario 1, the bull trap rally. This is the one that feels amazing, but sets up the biggest pain. Silver rallies hard over the next 4 to 6 weeks. We're talking 115, 125s, maybe even 135. Everyone gets you for it. YouTube is full of $200 silver by April videos. Reddit is celebrating. New buyers flood in at the top, and then seemingly overnight it reverses hard. Silver drops from $135 to $95 in 3 weeks. A 30% collapse. Volume is massive. Fear is everywhere. Headlines scream. Silver bubble bursts. Everyone who bought between $100 and $135 is underwater. Panic selling accelerates. Silver briefly touches $80. And that's when the real bull market begins, because all the weak hands are gone. All the leverage is wiped out. All the tourists left. And silver quietly starts climbing again. $100 $10 to $120. But this time it doesn't stop. This time it's real buyers, industrial users, institutions, people who understand the fundamentals, and silver goes to $200, then $250, then higher. But most people who held at $160 today sold at $95 during the shakeout. They survived the whole journey up to $135 only to give up at the worst possible moment. Scenario 2, the slow bleed. This one is psychological torture. Silver doesn't crash dramatically, it just slowly grinds lower. $106, $102, $98, $94. Week after week, month after month, no dramatic collapse that would signal a bottom, just endless soul-crushing decline. Every bounce gets sold, every rally fails. 3 months pass, silver is at $91. You've watched your position lose 15%. Every day you check the price, every day it's lower. Your conviction starts to crack. Maybe the bull market is over. Maybe I'm wrong about the fundamentals. Maybe I should cut my losses. Finally, after 4 months at $80 you sell. You can't take it anymore. And 2 weeks later, silver is back at $105. 4 weeks later, $118. 8 weeks later, $142. You held for 4 months of decline, but gave up 2 weeks before the turn. The slow bleed broke you. It was designed to break you. Scenario 3, the volatility whipsaw. This is the chaos scenario. Silver doesn't go straight up or straight down. It does both violently, repeatedly. Up 8% in 2 days, down 12% in 3 days, up 15% in a week, down 10% overnight. No clear direction, no readable pattern, just constant violent swings that destroy your ability to make rational decisions. You try to trade it. You sell at $112 planning to buy back at $100. It goes to $125. You panic buy at $123. It drops to $18. You sell in frustration at $110. It rallies to $135. Every move you make is wrong. Every decision costs you. Finally, exhausted and demoralized, you give up. You sell at $115 just to escape the stress. And that's exactly when the volatility stops. Silver trends smoothly to $180 over the next 6 months, but you're not in it anymore. The whipsaw accomplished its purpose. It shook you out. 3 scenarios, all different, all leading to the same outcome. Most holders sell before the real move happens. And here's why I'm telling you this, because if you know these scenarios exist, if you've mentally prepared for them, you have a chance to survive them. Knowledge is armor. Preparation is strength. The person who's never thought about a 30% drawdown will panic when it happens. The person who expected it, who planned for it, who understood it, was part of the journey that person holds. Now let me give you the framework that will help you survive what's coming. I call it the 3-pillar system. Pillar 1, conviction based on fundamentals, not price. Why are you holding silver? If your answer is because the price is going up, you're doomed. Price is the worst reason to hold anything. Because when price goes down, your reason to hold disappears. You need deeper conviction. Industrial deficits, supply constraints, monetary debasement, geopolitical instability, these are fundamentals. They don't change because price moved 10%. If you understand that global silver production is in deficit, that China restricted exports, that industrial demand is growing 15% annually, that JP Morgan holds $750 million ounces, then a price drop from $106 to $95 doesn't change your thesis. The fundamentals are still intact. The reasons you bought are still valid. Price is just noise. Fundamentals are signal. Pillar 2, position sizing that allows you to hold through anything. If you're holding so much silver that a 20% drop makes you lose sleep, you're positioned wrong. The correct position size is the amount you can hold through a 40% drawdown without panic selling. Think about that number. Really think about it. If you're holding $50,000 in silver and it drops to $30,000, can you handle that? Can you hold without emotional breakdown? If the answer is no, your position is too big. Cut it in half. Cut it by 2-3, because surviving the shakeout is more important than maximizing potential gains. The person who holds $20,000 through a 40% drop and rides it back up 300% makes more money than the person who held $50,000, panicked at 30%, sold, and sat out the rest of the move. Position size determines psychology. Psychology determines results. Pillar 3, time horizon that extends beyond short-term volatility. If you're thinking in terms of weeks or months, you're thinking wrong. Bull markets and commodities take years to play out. The gold bull market from 2001 to 2011 took a decade. The silver bull market from 1971 to 1980 took 9 years. If you bought gold in 2003 planning to sell in 2004, you probably sold too early. If you bought silver in 1973 planning to sell in 1974, you missed the real move. The same is true now. The silver bull market probably started in 2020 when silver was $12. If it follows historical patterns, it runs until 2027 or 2029. We're not even halfway through. But that means years of volatility ahead, years of tests, years of shakeouts. If you can't think in terms of 5 to 7 years, you can't survive what's coming. 3 pillars: fundamental conviction, proper position size, long time horizon. If you have all 3, you can weather anything. If you're missing even one, you're vulnerable. Now let me show you the specific signals that will tell you which scenario is playing out, because while I can't predict the exact path, I can give you the warning signs to watch for. Signal 1, parabolic price action. If silver goes from $106 to $135 in 4 weeks, that's parabolic. That's unsustainable. That's a bull trap setting up. Healthy bull markets don't move in straight lines. They climb, consolidate, climb, consolidate. If you see vertical price action, prepare for a sharp reversal. It doesn't mean the bull market is over. It means a correction is coming to reset sentiment. Signal 2, excessive optimism. Watch YouTube, watch financial Twitter, watch Reddit. When everyone is euphoric, when every comment section is $200 silver guaranteed, when new channels pop up with clickbait titles about imminent price explosions, that's a warning sign. Markets top on optimism and bottom on pessimism. If you're feeling euphoric about your silver position, if everyone around you is celebrating, that's when you need to mentally prepare for a pullback. Contrarian thinking keeps you alive. Signal 3, record ETF inflows. Silver ETFs like SLV and PSLV publish holdings daily. Watch the flow. If you see massive inflows, hundreds of millions of dollars in a week, that's late-stage buying. That's retail FOMO. That's the crowd. And the crowd is always wrong at turning points. When inflows spike, a correction usually follows within 2 to 4 weeks. Use this as your warning system. Signal 4, mainstream media coverage. This is the big one. If CNBC starts running segments about silver, if Bloomberg publishes articles about silver shortages, if your uncle, who knows nothing about markets, asks you about silver, that's the top signal. Bull markets climb a wall of worry. They peak on widespread coverage. As long as silver is ignored by mainstream media, the bull market is safe. When it becomes headline news, prepare for a shakeout. Watch these signals. They'll tell you when scenario 1, the bull trap, is setting up. And here's what you do when you see them. You don't sell. You prepare mentally. You remind yourself that a 30% correction in a bull market is normal. You review your fundamentals. You check your position size. And you get ready to hold through hell. Now let me address the hardest part, the part nobody talks about, holding through paper losses. Because intellectually, everyone understands volatility. Emotionally, almost nobody can handle it. Let me paint you a picture. You're holding $30,000 in silver. This is the moment. This is where most people break. They can't take the pain anymore. They can't watch the number get smaller every day. They sell at 88. They tell themselves they'll buy back lower. They never do. And 3 months later, silver is at 165. They missed an 88% gain from their entry because they couldn't handle a 10% drawdown from their purchase price. The pain of watching a paper gain disappear was greater than their conviction in the fundamentals. Here's what you need to understand. That pain is engineered. Markets are designed to inflict maximum psychological damage. Shakeouts happen at the exact price level where the most people will panic. It's not random. It's not luck. It's how markets work. The weak hands get shaken out at the bottom. The strong hands buy from them. The strong hands make the life-changing money. So, how do you become a strong hand? You practice right now. Before the shakeout happens, close your eyes. Imagine silver at $88. Imagine your position down 15%. Imagine every day checking the price and seeing red. Imagine your friends asking why you're still holding. Imagine the self-doubt, the fear, the voice in your head saying, just get out. Feel that. Really feel it. Because when it happens for real, it won't be theoretical. It will be visceral. And if you've never prepared for it, it will destroy you. But if you visualized it, if you've mentally rehearsed holding through it, if you've decided in advance that you will not sell no matter what, then when it happens, you're ready. You expected it. You knew it was coming, and you hold. Now let me give you a controversial piece of advice. Stop checking the price. Seriously, if you're holding silver for a multi-year bull market, checking the price daily is toxic. It creates emotional volatility that has nothing to do with your investment thesis. Think about it. If you believe silver is going to 200 plus over the next 3 to 5 years, what does today's price matter? What does this week's price matter? Checking constantly just exposes you to short-term noise that triggers emotional responses. Here's what I recommend. Check the price once per week, Saturday morning. That's it. Spend the rest of the week living your life, not thinking about silver, not obsessing over charts, not reading every piece of news. Once per week is enough to stay informed, not enough to trigger panic responses. And here's what happens when you do this. Volatility smooths out. A 5% drop in a day becomes invisible when you only check weekly. A 3-day rally followed by a 2-day correction becomes a net positive week. You stop reacting to noise. You start seeing the trend. Your psychology stabilizes. Your conviction strengthens. Checking less makes you a better holder. Counterintuitive, but true. Now let me show you what the winners from previous bull markets did differently, because there are always winners. People who bought at the right time and held to the peak. What did they have in common? I studied this. I looked at interviews, blog posts, forum discussions from people who rode gold from $300 to $4,900, silver from $5 to $48, Bitcoin from $100 to $20,000. And there's a pattern. They all had one thing in common. They were bored. Not excited, not obsessed, bored. They bought based on fundamentals. They sized their position appropriately. They put their metal in storage or their coins in a safe, and they forgot about it. They didn't watch charts daily. They didn't trade around their position. They didn't try to time perfection. They just held. And years later, they checked. And they were rich. The winners weren't the smartest traders. They were the most patient holders. The losers, they were active, engaged, constantly watching, constantly adjusting, trying to buy dips and sell rips, and all that activity destroyed their returns. They sold before the real move. They traded themselves out of life-changing positions. Activity is the enemy of returns in bull markets. So here's my advice. If you're holding silver, become boring. Buy your position. Put it away. Check it once per week maximum. Live your life. And in 3 years, check again. You'll be shocked at where the price is, but only if you can resist the urge to be active. Only if you can resist the urge to trade. Only if you can be boring. Now let me address position building because some of you are thinking, should I buy more? Should I wait for a dip? Here's the framework. If you believe in the fundamentals, if you have a long time horizon, if you're properly sized, then dollar cost averaging is your friend. Don't try to time the perfect entry. You can't. Nobody can. Instead, decide how much you want to allocate to silver total, then divide it into 10 to 12 equal purchases. Buy once per month for the next year. Some purchases will be high, some will be low. Average them out. This does 2 things. First, it removes timing pressure. You're not trying to catch the bottom. You're systematically building a position. Second, it forces you to buy during pullbacks when your emotions say no. When silver drops 15% and you're scared, your scheduled purchase makes you buy. That discipline builds positions that make money. The worst thing you can do is wait for the perfect dip, watch silver run without you, then FOMO in at the top. That's how people buy at 135s and sell at $95. Dollar cost averaging prevents this. It's boring. It's mechanical. It works. Now let me show you the tax angle because almost nobody thinks about this until it's too late. If you're in the US, physical silver is taxed as a collectible. That means 28% capital gains tax on profits if you hold less than 1 year. Not the normal 15% to 20% long-term capital gains rate, 28%. That's brutal, but here's the thing. If you're planning to hold for 3 to 5 years anyway, this doesn't matter. You're going to hit long-term status, but it does mean You should absolutely not trade in and out because every time you sell and rebuy, you reset the clock and you get taxed at 28%. The hold and forget strategy isn't just psychologically better, it's tax efficient. Every trade costs you. Holding costs nothing. If you're outside the US, check your local tax laws. But the principle is the same. Trading creates tax events. Holding defers them. Be boring. Save money. Now let me address something that's going to tempt you. Silver miners. When silver rallies, miners outperform. A 10% move in silver can translate to a 30% move in mining stocks. The leverage is intoxicating, and you're going to be tempted to sell physical and buy miners to increase your exposure. Don't. Here's why. Miners come with operational risk, political risk, management risk, equity market risk. If there's a stock market crash, miners will get crushed even if silver is rising. If a mining company has a labor strike, environmental disaster, or permitting issue, the stock tanks regardless of silver prices. Physical silver has none of these risks. It just sits there existing. And you want leverage? Buy more physical within your risk tolerance. But don't trade the certainty of metal for the uncertainty of mining stocks unless you deeply understand those risks. Now the big question, when do you sell? Because holding forever isn't a strategy. At some point, this bull market ends. At some point, you need to take profits. So how do you know when? Here are the signals. Signal 1, parabolic blow off top. If silver goes from $200 to $350 in 6 weeks, that's a blow off. That's euphoria. That's the end. When price action becomes vertical and unsustainable, that's when you sell, not before. Signal 2, mainstream adoption. When silver is on the cover of Time magazine, when your Uber driver asks you about silver, when investment advisors recommend 20% allocations, the crowd has arrived, and the crowd is always wrong. That's your exit signal. Signal 3, fundamental deterioration. If supply deficits turn to surpluses, if industrial demand collapses, if China reopens exports, these fundamental changes mean the bull case is breaking down. That's when you exit regardless of price. Signal 4, historic valuation extremes. Silver at a 10-1 ratio to gold. Silver at 100x industrial demand. Silver at levels that have never been sustained. These extremes don't last. When you see them, sell. Watch for these signals. They'll tell you when it's actually over. Until then, ignore everything else. Let me leave you with this final thought. The next 90 days to 2 years are going to test you. There will be moments where holding feels impossible, where selling seems like the only rational choice, where everyone around you thinks you're crazy for staying in. Those are the defining moments, the moments that separate wealth creators from wealth watchers. The person who sells at $95 after buying at $98 because they can't handle a 3% loss, they miss the move to $200. The person who holds through $95. Through the fear, through the doubt, they capture generational wealth. Both started at the same place. Both had the same information. The difference was psychological fortitude, mental strength, conviction, and fundamentals over feelings. You have a choice. You can be the person who holds, or you can be the person who wishes they held. Both are real possibilities. Both depend on what you do in the next crucial period. If this video gave you the framework you needed, I need you to do something. Share it with someone else who holds silver. They need to hear this too. Most people are not prepared for what's coming, but you are now. Help someone else prepare. Subscribe to The Hidden Economy. I'm going to track this market through every twist and turn, every shakeout, every rally. You won't be alone in this. Drop a comment below. Tell me Diamond Hands if you're ready to hold through whatever comes next. I read every single comment. The rest is up to you. The test is coming. Will you pass? I'll see you in the next one. Stay sharp.